Thank you, Mia. Very happy to be here again. For those of you who don't know me, I'm Kevin Oates. I run this event and various other events. Today we have quite a full schedule. I'll try and keep as much as possible to time. We're going to kick off with a look at what the market is doing. Our speakers are Chara, Georgousi and Matthew Harrington, who are research analysts at Allied Shipbroking. And the title of the presentation is Must What Goes Up Come Down? Chara and Matthew, please.
Good morning, everyone. It's truly a pleasure to be here at Marine Money, and I'm excited to be back after attending Marine Money Korea last year. Speaking to such an esteemed audience today is truly an honor. As you're all aware, we're in the midst of a fascinating time for the industry, where both historical patterns and unprecedented events are shaping the market in ways that demand close analysis and foresight. Today, we'll delve into the key trends we're observing in the market, particularly in the dry and tanker sectors. We'll discuss what's driving market highs and why today's market is different from the boom-bust cycles of the past. As we review the data, from freight rates to asset values and S&P activity, we'll share some insights on the risks and opportunities that lie ahead. Our industry, as always, is influenced by numerous factors, from geopolitical events like the Ukraine war and Red Sea, to global trade shifts driven by elections and environmental regulations. These forces are shaping how we operate, and it's essential to understand their potential impact moving forward. So let's dive into the numbers and stories behind them so we can better navigate the opportunities and challenges ahead.
So last night we had a really nice analogy describing how shipping is in increasingly hot water. And I think these charts show that pretty well. We had a remarkable period through COVID, an even more remarkable sort of conflict which sparked sort of unbelievable highs in tanker markets, and then we had OPEC cuts in the Red Sea that followed. This was by no means just a tanker thing, and we've seen a pretty severe response in the dry bulk markets too. But I think overall, maybe it's been slightly less sort of acutely affected. So we sort of all know where markets are at. We know everything's running sort of well, but for unfortunate reasons. And I think the question that everyone's wondering now is, where might we go next? So I definitely remember from the first half of the year, there were a lot of questions saying, is this another 2008-9? How can things be this high? We can see the headlines here. I don't think the charts on the bottom are what's coming next. One very fundamental reason, these two charts here. Grouped on the left, we have sort of the fleet and order book then, we have the fleet and order book now. Even though tanker ordering is picking up quite a lot, this is just not the same scenario. So while things may soften, we have a lot of tensions to unwind. I think the fundamental argument here is things look super manageable overall. We're now going to give a sort of quick overview of fleets, how they're aging, because this is one of the big factors at the moment. And after that, we'll sort of talk about Newbuilding, order book trends behind this, and then turn to what this means for the sale and purchase of ships.
Exactly.
We're going to begin with some projections based on the current delivery schedules for 2025, 2026. I extended this a little to 2027 based on the pace of the next 2 years. And over those time frames, we have three scenarios. At the top, you can see demo rate at the 10-year low, demo rate at the average of the past 10 years, and the demo rate at a high level. And we'll discuss how the fleet will grow under these assumptions.
So we will now begin with the tanker sector. When examining today's fleet demographics, it becomes clear that the substantial portion of the fleet is nearing at the end of its operational life, and this raises important considerations regarding future scrapping activity and newbuilding demand. This slide provides a clear picture of how different segments of the tanker market might evolve, depending on demolition rates and the current delivery schedule. On the right, you can see three potential scenarios for fleet growth. Beginning with MRs, we notice that demolition needs to ramp up considerably to keep fleet growth below 3%, because without higher scrapping, the market could become oversupplied, putting downward pressure on freight rates. For Aframax and Suezmax tankers, if demolition stays low, these fleets could grow much faster than demand, posing a risk of oversupply. Owners need to be aware of this potential imbalance, especially if global demand doesn't rise in line with the expanding fleet. In contrast, the VLCC segment is in a different situation. Even with minimal recycling activity, fleet growth here remains modest, which could help maintain a balanced supply-demand environment. Meanwhile, the following slide brings us to an important topic, the aging of the tanker fleet. Under the same assumptions we've been discussing, the continued aging of the fleet is inevitable. As we look ahead, a significant portion of the fleet is becoming increasingly liable for scrapping. While this growth may seem concerning, it could actually help limit the duration of any future market downturn by balancing fleet supply. For MRs, we're seeing that a quarter of the fleet is likely to be vintage, that's 20 years or older, regardless of how quickly scrapping occurs. This highlights the need for more new builds or recycling efforts to prevent fleet overaging. For Aframax tankers, maintaining a high rate of recycling is crucial because without it, the portion of the fleet that's over 20 years could exceed 20%, and this could put pressure on supply demand. In the Suezmax and VLCC segments, though, the situation is a bit different. Even though these tankers are at 15-year highs in terms of age, they won't face the same immediate pressure from the aging fleet. However, because of the lower order book and fewer deliveries, which are expected, there's less flexibility for demolition in the segments, meaning the fleet will likely continue to age without significant intervention. Matthew will now continue with the dry fleet.
So in terms of dry, it's quite a different picture overall, with the same baseline assumptions on scrapping and how we've looked at deliveries. It's mainly the sub-capes, so handies up to Kamsarmaxes, that are going to experience the biggest growth, particularly next year. But beyond that, things really look quite manageable. This is all obviously manageable based on fairly steady 3% growth in volumes for the coming years. But even if that doesn't sort of manifest, if you look at the bottom row of the table, if we have the highest demolition rate that we've seen in the past 10 years, or something close to it in the coming years, it's very, very, very easy for the fleet to sort of balance itself. In terms of capes, it's a very slim order book in the previous few years that means that we're going to see quite low growth. So from there, I think a good few years are coming. In particular, you might notice on the chart just how insane the fleet growth was 15 years ago. This was the real cause of the crunch, and we're just not approaching that now. In terms of an aging fleet, the picture is much, much better. Right now, this is a tanker problem, and we can see that the dry bulk fleet is not really going to have more than a fifth over 20 in the coming years, with very, very modest levels of demolition. There is sort of one hidden time bomb here, and that's that the bulk of the dry bulk fleet is concentrated around 10, 15 years old. So in 5 to 10 years' time, we'll likely see what we're seeing now in tankers. Just for context, the number of capes that are between 10 and 15 is roughly equal to the number of capes in the 10 years below that, from 10 and below. So it's pretty badly skewed, and it will sort of catch up with us in the near future. So now we'll sort of see what's going on in the new building scene and how that's motivated the order books and growth that we just explained.
Thank you, Matthew. So when we examine new building asset prices, it's impossible to miss the surge that's taken place since 2021. Prices have been climbing steadily, approaching the record highs we saw during the previous supercycle. What's remarkable is that the rise continues despite an abundance of shipyard capacity, largely driven by strong contracting activity and a shortage of early delivery slots at top-tier shipyards, especially China and South Korea. Tanker contracting has been robust, fueled by strong performance in both crude and product tanker sectors, and supported by an aging fleet. This combination has pushed the tanker order book to around 12% of the existing fleet, which is a staggering threefold increase since October 2022. In the dry bulk segment, Capesize contracting has taken the spotlight, even in the face of rising new building prices, which are up by 12% this year alone. However, the smaller sub-Cape vessels haven't seen as much activity. And that said, they aren't facing significant supply challenges or aging fleet concerns in the near future. Overall, contracting in the dry bulk sector is down by more than 25% compared to last year, reflecting a more cautious approach from owners. As we assess the current state of shipbuilding, one significant trend emerges. Power is becoming more concentrated in fewer shipyards, particularly in China. Major Chinese yards are reopening dry docks and increasing labor to handle the rising demand for new vessels. It's clear that the industry is responding to the surge in orders, but there's more to the story than just supply and demand. New building prices are on the rise, and it's not only due to demand. Several cost pressures are at play. Steel prices remain high, labor costs are increasing, and vessels themselves are becoming more advanced. Today's ships are no longer just cargo carriers. They're equipped with energy-saving technologies and dual-fuel engines, which add to the overall complexity and expense. Even if material costs fluctuate, these additional factors are likely to keep prices elevated for the foreseeable future. Looking ahead, fleet renewal isn't just on the horizon, it's inevitable. Many ships built in the early 2000s are nearing retirement, and the stricter decarbonization regulations approaching, the need for new vessels is unavoidable. While prices may stabilize eventually, managing shipyard capacity effectively will be crucial to preventing delivery delays and ensuring a balanced market. Now, if we look at the charts, you'll notice how delivery times have changed. A few years ago, the majority of ships were delivered within 2 years. However, today's most deliveries take 2 to 3 years, and this extended timeline is unlikely to shift in the near future. But now let's examine how these trends above have been reflected in the S&P market this year. I will begin with the trends spotted in the tanker market, and then Matthew will take over, analyzing what we've seen in the dry bulk market. So the tanker S&P market has witnessed reduced activity in 2024 compared to the previous 2 years, mainly due to inflated asset values and softening freight rates. More specifically, we've seen 367 vessels being sold this year so far, and that is a significantly lower figure compared to what we witnessed the previous 2 years. Starting with the VLCC segment, it's holding firm, particularly in younger tonnage. We've recorded 47 sales, down from 81 last year, but this is still significant considering the market conditions. A key trend here is the dominance of Chinese buyers, who account for over 21% of acquisitions. This trend continues from previous years, as China is strategically expanding its fleet, both state-owned and private, to strengthen its control over oil logistics and secure energy supplies. Also, Greek buyers have maintained their position as key players, though they've taken a more cautious and selective approach, I would say. On the pricing side, modern tonnage has shown remarkable resilience. A 5-year-old vessel is now priced at around 116 million, which is 47% higher than the 5-year average and reflects steady demand for efficient and eco-friendly tonnage. On the other hand, the Suezmax segment tells a slightly different story. Sales have totaled 21 vessels so far this year, and despite the lower numbers, interest remains strong, particularly from China and Greece, which together accounted for nearly 30% of the acquisitions. Interestingly, we have seen Turkish buyers gradually becoming more active in the segment in their efforts to expand their fleets to boost oil transport capacity in the Black Sea and Med regions. Older Suezmax vessels, particularly those around 19 to 20 years old, have seen strong demand, and that is mainly due to their high involvement in the shadow fleet. Indeed, according to our data, approximately 40% of Suezmax vessels are now trading in opaque markets. As a result, prices for vintage tonnage have jumped nearly 19.5% in the past year, with 20-year-old vessels now valued at 34.5 million, nearly double the 5-year average. Turning to Aframaxes, we've seen 56 vessels being sold this year so far, though volumes are down compared to last year. Southeast Asian buyers, especially from Malaysia, Indonesia, and Vietnam, have increased their activity, driven by rising transport fuel demand and growing refining capacity in the region. This makes absolute sense if we consider that port limitations and short trade routes make Aframaxes ideal for those regions. Owners seem to be increasingly attracted by older units, especially those aged between 16 to 20 years old, with many of those vessels acquired to eventually enter the shadow fleet. This preference is also reflected in values, holding prices for older units firm. Indeed, a 10-year-old vessel has seen a 14.5% price increase over the past year, though the market has started to stabilize recently. However, the key area of focus this year has been the MR tanker market, with sales in the segment making up almost half of the tanker sales this year so far. Greek buyers have been especially active in the segment, surpassing their totals from last year. Asia, too, has shown growing interest, with buyers from China and Singapore, reflecting the region's expanding refining capacity and increasing intra-Asian trade. Interestingly, we have seen demand for younger tonnage firming this year, with prices rising sharply. Indeed, a 10-year-old vessel has seen its value increase by 27% year-on-year, with the largest gains in the 5 to 10-year age group, where vessels are now priced 60 to 70% above their 5-year averages. Now, Matthew will take us over to the dry bulk markets and what we're witnessing so far.
Yeah, so it's sort of finally been quite an exciting couple of years for the dry bulk. They've stolen the limelight this year. Ignore that statistic, it's not down 27.4%, that's from the tanker. It's actually going to, I think, easily exceed last year, probably by more than 20% by the end of the year. In particular, China is the driving factor again, from capes down to the smaller sizes. Like, just watch China and you'll see what happens with the sales. If we think about this response, we can see it on these charts here. So those light grey bars, these are the sort of older units. I think you can pick almost any one of those this year, and that's gone to a Chinese buyer. I think this trend will carry on because there's major investment happening in places like West Africa with the Simandou mine for iron ore. And as for the VLs, Chinese owners are wanting to control sort of the entire chain, from production all the way through to getting those commodities back. So they're also quite price insensitive buyers. They were strong buying last year, they were strong buying now. I think it will carry on. For the smaller sectors, it's a bit more interesting, particularly for the Kamsarmaxes. They've had a really, really sort of interesting year. And the rise and fall of 10-year-old asset prices for them is sort of remarkable looking back over the last few decades. You could have seen a 10-year-old unit rise by 3.5 million and fall by the same amount, all within the last 12 months. This is quite an exceptional swing. I think the dark blue bars on the bottom for the Kamsarmaxes show just how much demand there's been for modern units, and this is what was driving this very fast rise in asset prices. Summer, though, was a different story. The Kamsarmaxes have really underperformed lately, particularly like relative to the capes, but also to the Ultramaxes, the smaller sector underneath. And this really seemed to sort of halt the interest and make people question whether now was the time to be buying these overpriced units for ESG emissions reasons with a sort of long-term horizon, when the short-term charter market just didn't make sense. The Ultramaxes have had an amazing year. They look very, very favorable on a sort of price-to-earnings ratio, and we've already matched the number of vessels sold last year. One extra little interesting point here about China is that the steel exports have just been amazingly supportive of older Supramax tonnage. So typically, Japanese vessels hold their value better, but what we're seeing this year is that steel exports are ideally suited to Chinese-built Supramaxes. So even as the rest of the market is softening a little bit around them, they're holding steady because they can make more money on this trade. So if we see that carrying on into next year, there's sort of like a little pocket of resistance holding out where we might not expect it in the market. So I think that's a pretty nice summary of what we've seen with the S&P. And the big question now, I guess, is everything is at highs, highs, highs. We're waiting for some things to unwind, and what might that look like?
Exactly. So as we look at the current state of our markets, we're fortunate enough to experience extreme euphoria amid the highest returns in decades, and while the market forecasts point towards a continuation of this market upside in the coming years, we indeed believe that there is no looming crash on the horizon, at least to the extent we witnessed back in 2008. However, history reminds us that markets can shift rapidly. The situation in the Red Sea continues to be both a source of support and concern for tanker markets. While rerouting has temporarily lifted freight rates, the recent escalation following Iran's missile attack on Israel has raised fears of a wider conflict in the region. A major concern is the potential closure of the Strait of Hormuz, which would likely cause oil prices to spike and tanker rates to rise initially. However, in that case, there are not many viable alternatives to bypass the strait, so this means that a prolonged closure would lead to an oversupply of tankers and eventually drive rates south. Further complicating this outlook is the risk of retaliatory strikes in Iran's oil infrastructure, which could eventually disrupt severely global oil flows and push prices even higher. While this might increase demand for alternative oil shipments and benefit tanker owners in the short term, reduced Iranian exports would eventually create an oversupply of tankers, leading to a fall in rates. However, we believe that the tanker sector is now much better positioned than it was back in 2009 due to OPEC's proactive production adjustments to balance supply and prevent extreme price swings. Additionally, US sanctions on major oil producers like Russia, Venezuela, and Iran, along with the strategic use of the SPR to manage prices, have further stabilized the market, supporting rates in both rising and falling conditions.
Perfect. So we also, everyone knows, Ukraine-Russia is a sort of very uncertain duration conflict. But because of how embedded now both sanctions and the shifts in fleet are, this is not going to be one that reverses overnight. There's sort of an outside factor that's almost more important here, and that's the US election, because it has the potential to change the duration and severity of both what's happening in the Red Sea, but also in Ukraine. And that's a bit of a wild card. I guess we'll know in a few weeks, but I think that's the one to watch to really see the path and the longevity of the other two. We are expecting, I think everyone's expecting at some time, things to unwind, but the impact on that could be quite severe. We have some charts here that illustrate a kind of worst-case scenario, imagining if all of the build-up in ton miles and extended distances we've seen in the past 2 years were to sort of unwind in sort of one go.
Exactly. Focusing on the trade flows, the following slide quantifies this shifting trade flows on sailing distances and ton miles in recent years. In 2023, we saw an increase of 3.1% in average sailing distances, largely due to sanctions in Russia. And projections for this year estimate an even larger increase of 5.3% following the conflict in Red Sea. When factoring in volume growth, the total impact was an increase of 5.5% in increase in ton miles in 2023, and an expected 5.9% in 2024. However, the critical question is, what happens next? If geopolitical factors unwind, which is slightly impossible, and sailing distances return to previous levels, while total volume rises modestly by 1.4%, we could see a significant drop in demand, with ton miles potentially declining up to 7.3%.
Yeah, and in terms of dry, as I said at the start, it feels like it's been less supported by what we've seen over the past few years. So again, we've got a more modest build-up in average sailing distances. So for the past 2 years, it seems to have extended by 2-3% only. It's quite a lot. While growth in sort of volume terms has been fairly steady, 2.63-ish%. If this carries on, we can see that the 3.5% rise we're banking on at the same rates from the past few years is going to do a pretty good job at mitigating any dramatic reduction in sailing distances if overnight things went back to normal from a few years ago.
So now that we approach the end of this presentation, it's clear that we're in the middle of a period of rapid change. While today's market may seem firm, we know that conditions can shift quickly, and staying ahead of these challenges will be crucial. This is where real-time market intelligence becomes invaluable. Understanding the forces at play, spotting the trends before they fully materialize, and making informed decisions will set apart those who thrive from those who struggle. At the end of the day, it's not just about weathering the storm, but about navigating it with precision. Our team is here to support you with the insights and expertise to do just that. So if you'd like to explore how we can help you stay ahead of the curve, we'd be happy to connect with you and continue the conversation during the break. Thank you for your attention.
Thank you.